This is the 401k Fridays podcast, and I'm your host, Rick Unser. If you're an employer, retirement plan sponsor, or plan fiduciary, and you want to hear candid insights from retirement industry leaders on important trends, topics, and current events, you've come to the right place. Each episode is designed to explore a specific topic and leave our listeners with concrete ideas and strategies to enhance fiduciary protection, streamline plan operations, or improve participant retirement readiness. I'm glad you found us, and here we go with this week's episode. In case you hadn't noticed, target date funds are kind of a big deal in workplace retirement plans. My guest, Jeff Holt, a director of multi-asset strategies at Morningstar and one of the authors of their 10th annual Target Date Landscape Report, cites their use as default funds in retirement plans as one of the key reasons they just hit $1 trillion in assets at the end of 2017. During our conversation today, we discussed the significance of that accomplishment and hit on a few other highlights from their report, including thoughts on the flood of money into quote-unquote passive target date funds, how target date funds are actually performing, whether you can glean useful information by evaluating their underlying holdings, and how the competitive environment in target date funds is affecting the industry. Also, don't miss our discussion on a newer statistic Morningstar has developed comparing the cost of target date funds with the percent that they have in indexed or passive strategies. Whether you're a target date fund novice or grizzled veteran, you'll definitely be able to take something away from our conversation today. Now, if you feel we missed something on target date funds, let me know, and we can tackle it on a future episode. Shoot me an email to feedback@401kfridays.com, and we'll look into it. Now, wherever and however you might be listening, enjoy. Well, Jeff, welcome back to the podcast. I'm excited to have you and looking forward to tackling what seems to be our favorite topic of conversation, target date funds.
Well, thanks for having me, Rick.
Well, on that note, timing is good. I know you guys just put out your Morningstar target date report. I know it's got a fancier name than that, and would love to just kind of get some of your thoughts on the headline there, which was target date assets just hit $1 trillion. That's a big number. So as you're kind of talking through that a little, would love if you can maybe frame that and just share if you guys have seen growth in any other type of asset class, like we've seen in target date funds over the last several years.
Well, target date funds have definitely seen a remarkable growth. Just to put the $1 trillion into context, so at the end of 2008, there was only $158 billion in target date funds. And so in that 10 years, you've seen assets grow to over $1 trillion. And what's been really driving that is the remarkable part is that it's just been consistently strong growth. So each year since 2008, there's been at least $40 billion in estimated net new flows going to target date funds. And 2017 was a record year for estimated flows, and we saw roughly $70 billion go into target date funds. So again, that was an all-time high. And when you put that strong trajectory of growth, the year-over-year strong growth, that is remarkable compared to a lot of other areas, whether you look at like U.S. equity funds in general or international equity funds, or even more niche areas like commodities or municipal bonds. And those asset classes, you tend to see them come in and out of favor at times. So they'll have a year of strong growth or a few years of strong growth, and then they'll have some outflows. But with target date funds, it's just been year over year, just positive flows to the funds. And a lot of that has been just because, as their prominent role as a default investment in so many defined contribution plans. And that causes the funds to really be a viable investment for investors across their different stages of their working career. So young investors starting their career are putting contributions in, and we're also seeing strong flows from investors that are approaching retirement. So just strong growth across the board, and the outlook for growth is strong, and there doesn't seem to be anything that would really impede that growth because they're structurally in there as that default investment.
What else did you guys have as some of the key observations or takeaways from your report that you guys just put out? And maybe what's the true fancy name for that if people want to find that?
Yeah, so the report is our 2018 target date fund landscape report, and it's our 10th annual report. So we've been doing these for several years now, and it's an opportunity. I mean, so as at Morningstar, as on the manager research team, we cover and set ratings out on for a lot of target date series out there. So we're in regular communication with a lot of the target date managers. But the landscape report is actually an opportunity for us to take a step back and look at the landscape overall, and to make and also to dive into certain areas that are of interest that we're observing in the landscape. And one of the big observations of 2017 was just the amount of the flows to passive target date series. As I mentioned, 2017 was a year of record flows to target date funds. When you look at it versus active versus passive target date series, passive series saw 95% of the estimated net flows, which is building upon a trend that we started to see the last couple of years. But I mean, to see 95% go to passive target date series was very, very remarkable.
And on that note, I mean, I don't know. I believe in kind of the pendulum in the financial markets, and, call me crazy, but when I see that pendulum swing so far in one direction, in this case, 95% of flows into passive target date funds, that gives me a little pause and makes me at least kind of scratch my head for a second and say, okay, is that a good thing? Again, I've got my own opinions there, but I'd love to get your thoughts. And is that a good thing that so much money is flowing into passive funds, or are there things that retirement plan fiduciaries, investors should be thinking about as all of that money has flowed into those passively managed target date strategies?
It's a very good question, and it's the same as we approach this year's paper, and noticing that we saw that much of assets go to passive, that shaped the rest of the paper as we dived into different areas of evaluating the active versus passive in several different aspects. But to your question, is it is a good thing? I think it really has to go back to the concept that there is really no such thing as a passive target date series. So when we're defining passive target date series, we're defining it as a target date series that invests predominantly, in our definition, more than 80% of their assets are in index funds or ETFs. But even though they have that quality to them, or that attribute, there's still a lot of decisions being made by a target date manager that's even running a passive target date series. They're still deciding what the equity glide path will be. They're still deciding the underlying mix between the sub asset classes. And when I say that, I'm talking about the split between U.S. and non-U.S. equity, whether to include foreign bonds or not include foreign bonds, how much to include in tips. These are all decisions that a passive target date manager is making, just like any active target date manager. So that context is necessary in evaluating target date funds.
So Jeff, just on that thought there, I mean, so many people that that I come into contact with, whether it be at companies that are sponsoring retirement plans and their committees, or those in the industry, and everyone really just touts passive this, passive that, and just kind of furthering those thoughts there. If they do, like you were saying, have an actively managed glide path, I mean, can they really be considered a passive fund? Or if someone truly is looking for a passive strategy, should they just be buying the S&P 500 index?
Well, so let's say, I mean, in that case, like the S&P 500 index, what the intent of getting that exposure, if you're buying that, is to get beta exposure to the U.S. large cap stocks. But the hard thing is there is no beta exposure for retirement income, or there's asset allocation decisions being made for any and every target date series, whether they're conscious decisions that they're making proactively, or whether it's just the fallout of how they've designed it. There's decisions being made behind target date series. But what the interesting thing is when we looked at the flows, we saw the flows go heavily to past target date series. But we took a step deeper in looking at the fees for the funds. And it's apparent that the main driver to the passive series is it appears that it's driven for fees rather than more so than a concrete belief in that passive management is superior than active management. Is because we broke out the fee levels. So for at Morningstar, we divide every fund into one of 5 fee buckets. It's either it can go from average to below average to low fees, or it can be above average fees or even high fees. And if you looked at flows, the only 2 areas in 2017 that saw positive net flows was low or below average fees. And in some cases, there's series that have gained flows that are active series that invest in, they're active in the sense that they buy underlying active funds, and they did see positive flows. And there are other passive series that are high priced that didn't see flows, that didn't see positive flows. So again, while the 95% went to passive, it appears that it's more of a heightened sensitivity to fees and an appetite for low cost rather than a strong belief in passive management.
And that's consistent, I think, with what we're seeing in the workplace environment, in that there's been so much focus on fees, whether it's driven by lawsuits or just driven by, industry narratives. And I think maybe just would love to get your thoughts here too, that, a lot of times, obviously, low fees and passive kind of go together. And certainly over the last couple of years in the market, thinking back to 2016, 2017, there's been a pretty strong argument that passive's been a good place to be, just based on what we've seen in those market conditions. So yeah, I think those all kind of play into everything you guys are seeing.
And target date providers, the firms that are building the target date series, they've noticed that there's this appetite for fees. That's pretty clear. And what we've seen, so initially 10 years ago or 10 plus years ago, when the target date manager came to market, they had a single target date series, and they came to market and said, this is our target date approach, and this is why we think it's the best approach, and this is how it is. But then in 2008 was the first one, but we've seen it happen more and more, is that there's been more of a willingness for target date providers to offer multiple series. So sometimes they even offer 2 or 3 series. And one of the main differentiators that many of them do is, if they came to market initially with the active series, they followed up with one that followed a similar asset allocation approach, but invested in index funds. Or they possibly might have blended more index funds with an active series. And the goal in those cases is to offer a lower cost offering. So one thing we did this year is that as we've observed this, and we've seen because right now we see there's about 60 target date series in the mutual fund space, but there's really only about 40 target date providers. So you can see that there's a lot more series per provider nowadays. But what we did is we looked at the performance from when some of these providers that have launched multiple series, when they launched their most recent one, have investors been better off by moving to the newer, and most frequently it's cheaper, target date series? And in some cases, it found that it was correct. Investors were better off by going to the index fund. But in several instances, despite the fee advantage of the passive series, they actually would have been better off on a risk-adjusted basis, staying with the other target date series, with the older pricier target date series, which seems counterintuitive, but it makes sense if the active target date series is adding value with the underlying active funds. And plus, one differentiation is that in many cases, the active series might have exposures to certain areas or niche areas that might not be included in a passive target date series. And so those can cause performance to diverge. And so there's not necessarily a guarantee by moving to the lowest cost offering that you're going to get better returns. And that just needs to be crystal clear to investors.
Unfortunately, I would say that that's not as clear to some as maybe it should be. But yeah, I think that we have kind of a dangerous mix going on right now, in my opinion, in that we've got a desire for low fees, which generally is leading people towards passive investments. And then, as you said, and I think as others has observed, just because it's the lowest cost or a low cost option doesn't always mean it's going to provide the best performance. And I love the word you use there, which is risk adjusted returns. How, as you guys are looking at the landscape of target date funds out there, just to use your words, how important is risk, especially as where we sit right now in, early 2017 or the first half of 2017, where, we still have a bull market in effect that's been going on for, about 9 years on the equity side of things. As you guys are looking at all this, how important is that risk return metric that you were talking about a second ago?
You can't look at target date funds without considering risk because, and actually, one of the questions I get fairly frequently is 2008 seems like a long time ago, but target date funds, and there was a lot of criticism and scrutiny over target date funds because a lot of them lost money in 2008. And sometimes I get the question, well, have target date funds evolved and changed? They won't experience those losses like they did in 2008. And the reality is that target date funds haven't changed dramatically over the last few years, but when they've actually assumed a little bit more equity risk than becoming more conservative just generally. And so the expectation should be that if we had another 2008 type scenario, target date funds would lose money. They're not intended to preserve capital. And I think that's when evaluating target date funds, it's imperative to put the proper context behind the funds in terms to set performance expectations. Now, I find that probably the best way to do that is to really understand how the portfolios are built and where their biases lie, and not just from an equity bond standpoint, but actually looking at the sub-asset classes and seeing, is the series more biased to U.S. large cap stocks than its peers? Is it more biased to high yield bonds than its peers? Because those differences will drive results. And so understanding those differences is necessary to really set appropriate expectations going forward.
And I want to come back to a comment you just made there a second ago, which is that glide paths have, or the way that people are managing that split, I guess, between equities and fixed income has trended a little higher on the equity side.
Right.
I think that's what I heard you say. So I guess my question is that just natural drift based on what we've seen from a strong equity market, or is that more purpose-built in that people have been increasing equity exposure intentionally over the last several years, which has caused, again, higher exposure along the glide path?
Yeah, so when looking at that, it is a result. It hasn't been dramatic over the last 5 years, but there are instances where target date providers, target date managers, they have increased the equity allocation strategically. So it's not like just that the portfolios drifted. It's like they strategically have upped the target allocations to equity. And that's happened over the last few years with a few providers. And the interesting thing is it's happened more so for investors in the middle of their career, not so much in the retirement phase. So we haven't seen a huge increase over the last 5 years for investors in the retirement phase, but more so for mid-career investors.
One of the other things that I really thought was interesting in your report was where, just kind of coming back to the passive side of things, you guys had some analysis in there which highlights cost versus percent of active management. Can you explain that in theory? Is that a new element in the report, or is that something you guys have been tracking for a little while?
It's something that, we're always reevaluating. As the target date landscape evolves, we're always looking at new and appropriate ways to better capture differences and to highlight differences between target date series. And so as I mentioned, with target date providers launching more series and lower cost series and introducing more of that blend active and passive management, the distinction between active target date series and passive target date series has become murkier. There's been more that fall within that 20 to 80% in active exposure. So they're not investing predominantly in passive. They're not investing predominantly in active. There's kind of a mix in between. And so what we've done is we've looked at each series and we plot them on a scatter plot to highlight what the cost is, the average cost is versus how much they have an active exposure in underlying funds. Because you'd expect active exposure should come at a higher cost. But what you don't want to do is if a target date series looks reasonably priced compared to an active series, or even maybe competitively priced compared to an active series, but holds half of its portfolio in passive funds, then that's not a good deal. You would expect the cost to be cheaper. So again, as it's gotten murkier between the active and passive distinction, it's more and more important to understand what the mix is underneath between active and passive, so you can really get a good sense of if you're getting a good deal for what you're buying in the exposure of the series. Because the reality is that you don't want to be paying the same price for a passive series that you would an active series. You'd expect the passive series to be much cheaper than a much lower cost than an active series.
And as you're explaining that, I don't know, in my mind, I was kind of thinking around the term of that some active managers get labeled with, which is they are closet indexers. Is there any relation there, meaning that like some, I don't know, let's just pick on large cap for a second, some large cap funds, their performance, their risk attributes, whatever the case may be, will be very closely aligned with their underlying index or benchmark, yet you're paying for active management. Is that a similar concern to what you guys are looking for, or is it you're going down a completely different path?
It's something that you keep in mind for the scatter plot that's shown in the report. Just looks at whether the underlying funds, the underlying holdings are active or passive. So it wouldn't capture if the underlying fund would be a closet indexer per se. But it points to the need to look deeper. So in cases like that, if you see a target date series that invests in active funds and it's very competitively priced, you should look at why that is that case, and try to identify the reason behind that lower cost. So again, it's a common story through target date funds on multiple aspects, whether it's looking at the team or looking at the process or performance or the price. It requires looking a few layers deeper than just looking at what the cost is, because looking at the cost is not going to just tell you the full picture in most cases.
Well, since you mentioned it, when people are looking at performance, what's your general sense for, how target dates have been performing over the last several years or more recently? And are there still a lot of naysayers out there that say target date funds aren't working? There was a headline the other day, just Warren Buffett saying that, hey, I don't think target date funds are the best place for your money. I don't know. Do you feel like since when you started this report 10 years ago versus where we sit today, is there still kind of that chorus of people that think target dates are bad? Or now that we have a little more of a body of work that some of them have produced, are some of those concerns or some of those naysayers starting to see that these are actually okay for the average investor to use?
I think there will always be naysayers on it. And the hard thing is, because target date funds are intended to be an all-in-one solution for an investor's retirement savings. And what it does is use age to decide a certain level of risk. But the reality is target date funds aren't customized to every individual. And so there will always be those that criticize it for that not everyone of the same age is in the same circumstance. And that's a criticism that I don't see going away. But in terms of performance, I think target date funds have gotten, they face a lot of scrutiny as being an all-in-one investment. I think they face it on both the upside and the downside. I think over the last few years, as the S&P 500 has definitely been, like, comparing to other asset classes, the S&P 500 is the place to be. U.S. large cap stocks, that's been the best investment. And that could cause an investor to question as they see a headline and saying how well the S&P 500 is doing, and they look at their target date funds and it's not keeping pace. Is that creating some concern? But the most important thing is to have the appropriate context for these funds. So over the last 5 years, yes, target date funds in general have lagged the S&P 500, but it makes sense why they've lagged. Because what target date funds are really intending to deliver for investors is a diversified portfolio. So in doing so, they'll never be the top performing investment. Because they'll have a mix of U.S. and non-U.S. stocks. They'll have REITs, and they'll have, on their bond side, they'll have TIPS and core bonds and high yield bonds, and a mix of different asset classes that are intended to smooth out the ride over the long term. So versus the S&P 500, to me, it's not a good benchmark for target date funds. But the interesting is they also face the scrutiny on the downside, as mentioned earlier, of like, if they lose money, there's a lot of criticism, but the reality is they're not immune from losses. They're a diversified portfolio, and in our report this year, we looked at a little bit how the target date funds in general have done versus the S&P 500 in down markets, and generally, target date funds do better than the S&P in down markets, but they still do lose money, and investors should be aware of that. So again, the important part is for investors to have the proper context of what the expectations should be for target date funds, and that's where target date providers and plan sponsors and those that are communicating target date funds to the investors, helping investors understand what they should expect in performance is a good thing.
One of my favorite quotes on the podcast came from Rob Arnott. I don't know if this was his quote or not exactly, but he said, hey, Rick, diversification, when it's not working, you've got too much of it. And when it is working, you don't have enough. So right. I think that kind of is a little akin to what you were saying there, is that, hey, if the S&P 500 is on fire, your target date fund or for that matter, a lot of other asset classes are going to struggle. But, if the S&P 500 flounders or heads in the opposite direction, then some of that diversification can be helpful.
Right, but the thing to keep in context is that it can be helpful in the downside, but it's not going to. They can still lose money.
Yeah, and I do think that I can't remember where I saw this, so I don't know. I'll research it and put it in the notes. But there was a poll the other day on target date funds that I think one of the major record keepers put out. I could be wrong, but it just said, what percentage of people believe target date funds won't lose money, and it was a shocking percentage. It wasn't 100%, but it was a shocking percentage to someone in the financial services industry saying, "Oh my gosh, if to your point, target date funds can lose money, and if there is this belief by a large percentage of the population that they don't lose money, we're misaligned."
Right.
I've heard you say process a bunch of times. We've talked about, I think, a few elements of that process that you guys think is important. I know another one you highlighted in your report was people. And what's good to know for employers or plan fiduciaries, as they are taking that deeper look, as they are getting, beyond some of the surface level numbers or statistics of their funds, whether it be current or others that they might be considering, what should they know, or what questions should they be asking about the people that are managing the target date strategies?
It's a good question, and it's something that it should be emphasized, is that because every target date series, there are individual, whether it be active or passive, are individuals making decisions for these funds. And so in this year's report, we looked at like all the manager rosters, and we looked at like what the average longest tenure on each series, and we did find some interesting things. I mean we found that 17 series had fewer than 3 years of longest tenure. So there's some series that don't have a long tenured managers, and whereas about 21 or about a third of target date series had the same manager for at least 5 years. And so having that tenure and understanding the team is very important, because when we see turnover in the target date managers, there's a change in philosophy or the change in views, and that can result in changes to the approach to a series that will change over time. So it's really important to understand who are the key decision makers behind a target date series. Now, the interesting thing is when you look at a target date, when a target date manager, for a mutual fund, when they file a prospectus, they have to list the target date managers. You'll note that for target date funds, the target date managers don't all play the same role. Sometimes the person listed is more involved with like the asset allocation, the glide path design. Sometimes it might just be somebody that is more involved with maybe the manager research aspect of it, like selecting the underlying funds, or it could be someone that's just implementing or rebalancing the portfolio using cash flows over time. So it is really important as someone that's evaluating target date funds is to understand who's making these decisions and is there stability in those decision makers over time, because that's really going to determine what the approach looks like over the long run. The one interesting thing is when you look at the portfolio managers, and we looked at it this year, because we saw that active passive shift with the massive flows to passive target date series into lower cost options, was looking at where managers themselves invest, target date managers invest in their series, and there's different thresholds, and what we found is that out of the 140 plus distinct target date managers out there, only 13 invested over at least $1 million in their target date series. And the interesting part, though, is that all of those managers invested in an active series, not a passive one.
And just to clarify, I mean, is that $1 million of their personal net worth, or what is that? What is the significance of that $1 million? The
$1 million is their own personal assets, so it's their own money. And so what we like to see with manager investment is we'd like to see managers that are willing to invest alongside their investors, because if they have conviction and approach, they should be able to put their money with their approach. And with target date funds, it makes perfect sense. I mean, these are all-in-one solution. Anyone could invest in these. And so if a target date manager is designing something for the average individual, they should be able to
eat their cooking, so to speak.
Eat their cooking, exactly. And so what we saw is that very few eat their cooking to the highest level extent. So the filings have different increments, and $1 million or greater is the highest increment. And so 13 target date managers are in that threshold. But we also looked at series when there's firms that offer multiple series. We looked at how the managers, because it's often the same managers across those multiple series within the same firm, we looked at where they invest. And almost always, there was only one case that wasn't the case, but almost always the managers invested more frequently and in higher amounts in the older, costlier target date series, the one that often has the active management behind it. And why I feel that that's an interesting observation is it brings the question of whether there's been this demand by investors, plan sponsors for low-cost target date series. But the question is that target date manager's highest conviction offering? Do they think that lower cost series is going to do better than the more expensive one? And looking at where their investment lies, it seems to show that they have more conviction in their legacy active series, that they feel like those ones are actually the better series. And so that's that's at conflict a little bit. So it's an interesting thing to note when we're looking at the target date managers.
Yeah, and I don't know. It kind of brings to mind for me some research that's been done between pension plans and defined contribution plans or 401k plans, where pension plans and those that manage pension plans tend to have a little more tilt towards active management, whereas, as you've noted, the tilt in recent years on the defined contribution side has been towards passive. I don't know,
Right.
maybe a parallel or something similar, but yeah, I mean, where, to your point, kind of those high conviction dollars, whether it's where am I investing my own money or in a pension plan, how am I investing dollars that, depending upon how those perform, could have a material impact on the company. And those are, again, kind of tying those a little bit together. I think what we're seeing, and I think what you're saying, is that that is, it's still a little tilted towards active.
Yeah, well, I mean that's what it appears to be. I've been looking at like where managers are putting their money, and sometimes I wonder. I mean, what comes up a lot when I get the question of like, why is everyone going to the low cost passive offerings, and it commonly comes up is that it's to avoid lawsuits, right? At this point, comparing fees, comparing expense ratios for target date funds is fairly easier than comparing performance because there are so many moving pieces with target date funds. But at some point, as all these series build up longer track records, I think there's going to be more closer look at how performance stacks up versus the different series.
I'm with you, and that is just like in so many things. It's kind of easy to line up costs. You can do that on a spreadsheet. You can do that pretty easily, and you can sort to the lowest cost option pretty quickly. But when you have to dig deeper and ask tougher questions, that's a little harder to chart out on a spreadsheet.
Right, but by no means am I saying that low costs are or even passive target date series are a bad thing. It's more so just saying that those selecting and evaluating target date funds need to look deeper. They need to look at they need to look at the firm behind that they're partnering with over the long term, their capabilities and commitment to the target data industry, and they need to look at the people making the decisions on, because we are finding those are the teams and the resources for target date funds has grown, and how the decisions of those target date managers is resulting in differences in portfolios. And just to touch on that point on the importance of target date funds, I mean, we started off our conversation talking about how they've seen such strong flows, and that's why, as a result, target date funds have become very important to a lot of asset management firms. In some cases, they're representing more than 25-30% of the firm's assets, and in other cases, and it's outlined in our report, we go by firm. There's certain instances where had it not been for positive flows to the target date funds, the firm would have been in net outflows. So there's a lot of attention towards target date funds, and that's why we see providers willing to offer multiple series to try to meet that demand, that low cost demand for that's out there for target date funds.
On your theme of looking deeper, when you're evaluating target date strategies, can you look at the data that fund family is putting out, whether it's performance, expense, risk adjusted return, some of the things you've talked about, glide path construction, whatever it might be, and just look at that and say, okay, great, that I get it. I understand, how the fund performs. I understand, how it's constructed. Or are there additional insights that you can gain by actually going another step and looking at the ingredients that they're using for that target date, whether, the underlying funds or the specific underlying holdings within that strategy? Does that give you anything additional, or is it just okay to kind of look at the high level information that comes out?
I think when evaluating target date funds, you definitely have to keep digging down in deeper layers. One of the most common common graphics you'll see on any website will be the equity glide path and show how equity glide path is over time. But from our perspective, you really find that you really gain a lot of insight when you look at the sub-asset class glide path. And you gain a lot of insight when you look at that on an absolute basis, but also on a relative basis. So when we like to look at it relative to like the common, the average, to understand where and when along the glide path a target date series is tilting into certain asset classes. And once you know when and where they're tilting, you can ask the question, why are they tilting that way? Is there any reason based on, I understand the firm, I understand what their underlying holdings, what their opportunity set of selecting underlying holdings that are available, universe of holdings. Is there any reason that drives that construct? And that insight is I think helpful in understanding the overall approach to a target date series. And in terms of the underlying funds, I think particularly for the series, for any series you want to look at the underlying funds, but particularly for the series that invest in actively managed underlying funds, you want to have a sense of how good those underlying active funds are, if they're meeting their objective. And in that, if some of those underlying active funds aren't doing well or aren't doing as expected, you want to know what that target date manager can do to rectify that situation. Do they have the ability to swap out with another fund, or are they more or less stuck with that fund and basically hoping for it to recover or for the firm to fix the fund? So by digging in deeper layers, it provides the proper context and to being able to evaluate a target date series.
One thing you mentioned a minute ago was some of the ways that they're either using or integrating various sub-asset classes can kind of give you a little sense on how that firm is leaning or what some of their tendencies are. I think that's what I heard. Correct me if I'm wrong. What did you mean by that? Or could you expand on, what insights that could provide someone who's evaluating various strategies?
Yeah, so as a part of the report in our parent section this year, we looked at where firms that offer target date funds, like where generally their assets are, whether it be in U.S. equity, non-U.S. equity strategies or bonds, and to get a sense of like where their core capability or where they might place their most emphasis on it. And that's using the assumption that if they have a lot of assets in an area, that most likely is the area that they probably focus on the most. And then you can look at it that perspective and then look at the target date series level and see like where they're leaning and see if that understanding the firm and then putting it next to the target date series, if it explains why they're leaning a certain way, or because a target date series might be leaning away because that's their strengths, and not so as much as that they have like a strong belief in that approach and that from an asset allocation standpoint, but those are the strengths and that's why they'll lean that way. It's the same when we looked at it as well as looking at the active passive decision when it comes to the firms. The firms that offer passive target date series have a lot of, just generally have assets in index funds or have a sizable amount of index funds in their business. And so it makes sense for most of those cases that they came to market with a passive target date series. So again, it's one of those questions that from an analytical standpoint, you're trying to evaluate how they arrived at what the current glide path and sub-asset class glide path look like, and try to understand what's driving that. And because once you identify that, you can understand how, if there's changes, how that could affect these glide paths over the long run.
Hey, as we start moving towards a close, one thing I would love any thoughts you have on would be, as we start to see a little more volatility in the equity market, as we are starting to see interest rates rising for the first time in, decades. What impact or what should employers be thinking about as they're evaluating target date funds, and maybe we're heading into some different waters, so to speak, in the markets than maybe we've experienced over the last decade since target dates have really been around and a popular option in workplace retirement plans.
And I think it really goes back to the concept that, because the market environment will change. It goes back to the concept that target date funds are meant to be a diversified portfolio. So in the truest sense of a diversified portfolio, ideally a rise in interest rates will be offset by something else in the portfolio. So that the target date funds aren't too exposed to any single risk. That being said, with the market environment as it changes, you can expect performance to change in how they rank. Like certain series have a lot more in U.S. stocks than international stocks. Some have more in non-U.S. stocks than U.S. stocks. If you see a change in leadership in terms of performance in certain asset classes versus others, you can expect to see certain series to do better than other series. And it might not be the ones that have done well most recently are going to do well going forward. And this is a part of our performance section of our report this year. We looked at like the performance rankings of target date funds. And even the series that have a good long-term record and have generally done very well, they generally have still a year where they'll be in the back towards the back of the pack versus peers when the asset class shifts against their favor. And we also see ones that have poor long-term results. They might, any given year, they could climb up to be the top target date, the top performer in a year. And so those ranks can flip and flop pretty quickly based on the market environment. That's why it's important to understand what the exposures are so you can set the proper expectations given the market environment. And another thing to keep in mind when it comes to performance for target date series is the dispersion between the funds in the same category, so like all 2030 funds and all 2035 funds. The dispersion is actually pretty tight, especially if you take out some of the extreme outliers in terms of we found that looking back over a few periods that the dispersion is even tighter for target date funds than it is for like a intermediate term bond funds. So again, there's a tight dispersion, so those ranks can flip and flop. So part of your initial question was the diversification. About susceptibility to the changes in the market environment. Diversification, that's what target date funds have been. That's the whole concept behind them, has been to provide some diversification to hopefully smooth out some of the bumps that come from certain areas of the market not doing well.
I know I've kind of bounced you all over the place here. So is there anything we missed or any, big revelations in the report that you want to highlight before we sign off?
One of the things that we didn't touch on specifically was the competition between the different target date providers and how that's shaking out. So in 2017, we saw Vanguard lead the way and just build upon their lead in terms of market share. They saw about $50 billion in estimated net flows in 2017. So by far and away the leader in 2017. And they were followed by American Funds, which notably is actually an active series. And they had about $24 billion in net flows. But then you actually saw that there was only three others that actually had more than $1 billion in estimated net flows in 2017. That was TIAA and BlackRock and State Street. But even though this area has been growing so much, a lot of firms have still been struggling to get a part of that growth. And we actually saw 17 of the 41 providers or the firms that offer target date funds, 17 of them had net negative flows from their target date series in 2017. So, but we still find that it continues to be an area where there's a lot of competition. There's new strategies continuing to come to market. Some fall by the wayside every year, but it's still just a very competitive market. And the one thing that we highlighted in the paper this year again was so most of our metrics and evaluation focused on mutual funds, but there are quite a bit of target date assets in CITs, and we did highlight some of the assets in some of the CIT assets in some of the target date providers, and that really opens up broadens the landscape to get a sense of the major players in the industry.
And as the saying goes, I think what I'm hearing you say is the rising tide of target date funds is not necessarily lifting all ships.
Right. It's still very difficult to get into the market and to steal market share, but because of the strong growth trajectory, we continue to see attempt after attempt to do so.
Well, Jeff, you've shared a ton of great stuff here. I really appreciate you being here again. How would you kind of wrap this up, or what are a few key thoughts you'd want to leave our listeners with as we sign off?
I think the main key thought would be to look beyond the price tag when it comes to target date series, when evaluating target date funds. There's a lot going on behind the scenes, and it's an area that, again, you really can't go passive in the true sense of passive. So it really requires a lot of evaluation for those selecting and choosing target date funds. So it's important to understand the firm, because these are intended to be a multi-decade investment. Understand who you're partnering with over the long run. Know the people who are making the decisions for the target date funds, because those are, even for passive series, they're making important decisions. And that helps you understand why they're built the way they're built. And then once you look at the portfolios and size up the different portfolios and see how they're different and look at performance, assessing performance is part of the process of evaluating target date funds. But evaluating target date funds really requires more than evaluating just the fee.
I appreciate your candor and your thoughts today. Again, I loved your report on the target date landscape. I will be sure to link to that on the website. I'll kind of share all that in the closing. Again, Jeff, thanks for being here, and I'll definitely look forward to catching up with you sometime next year as you guys have your most recent take on all this.
Yep, it's been a pleasure. Thanks, Rick.
Thank you. Great input from Jeff. Hopefully you took away as much as I did from that conversation. If you have anything that you want to share or that particularly stuck out to you, shoot me an email at feedback@401kfridays.com or shoot us a note on Twitter or LinkedIn. Love to hear what resonated with you, or, as I mentioned in the opening, if we missed something, let me know too. If you want to get a copy of the Morningstar Target Date Landscape Report, just go to the website at 401kfridays.com/Holt, HOLT 2018, and we'll have a link there for you. Thanks again for tuning in today, and until next time, I hope you make your Friday a 401k Friday. And now, for some disclosures. The content in this podcast is provided for educational and discussion purposes only. Investing involves risk, including a potential loss of investment. Lockton does not and cannot guarantee the future performance or specific level of performance, the success of any investment, or success of any strategy. Nothing contained herein may be construed as investment or legal advice.